All right, well, welcome everybody. As Ken said, this is the June session of the roundtable where the four of us hope to share some of our best ideas and hope that some of our best ideas perform better than they have. We are going to spend a little bit of time talking about your contribution to this effort in the past and how we'll have a little bit of an audience vote towards the end of the day. But again, this is just something that we've been doing on a monthly basis for the last couple of years. And again, reintroducing Ken Kavula is one of the ringleaders of the Mid-Michigan chapter, and he's chair of the Better Investing Advisory Board. Cy Lynch joins us from Atlanta, and he's been a national teacher and served in a number of capacities. And Hugh McManus, the third guy, we can't get the green hat off of Hugh. The hat is stuck. It landed on St. Patrick's Day, and it just won't leave. But again, welcome, Hugh. Again, if you have any comments or questions about this, you are welcome to write to Ken Kavula at the email address on the screen that is shown there. With that, let's kind of get underway. We'll get the housekeeping out of the way first. We're going to talk about real companies in real time. We're going to express opinions. We may own the companies we talk about. Everything we do here means that absolutely no investment recommendation is intended. If you've been around here long enough, you know that the ground rules are simply do your own homework, make your own decisions, and again, it's all part of educating and demonstrating in all that we say and do. Here's our agenda for tonight. Again, I'll finish up with a little bit of introduction and welcome. Again, we'll explain what we've been doing here for a while, but again, a special welcome to any of you who may be joining us for the first time or first couple of times. We'll talk about what we're about, talk a little bit about how well we've done, and then we go into a series of stock selections where each of us will present some ideas, and then we'll ask you to vote on there'll be 3 selections tonight when we get there. Here's just a little bit of background on what we have been doing for a couple of years. Again, we take this somewhat seriously, I would say rather seriously. We are trying to pick ideas that have a higher probability of long-term success. And to that end, we do hope that the overall aggregate or composite result of the work that we do here will achieve a long-term relative return of 5%. Now, we'd obviously be happy if we approach that. We'd be more than a little bit happy if we exceed that. We do like to see roughly 3 out of 5 or 60 to 70% of the selections that we make actually outperform a market benchmark from the time of selection, and we do make those comparisons. We won't spend too much time talking about that tonight, but that is how we measure things. Here's a look at how we've been doing. And I guess we can give you a little bit of a collective groan, only to really acknowledge that we're doing better, believe it or not. We actually had much tougher results here in the past. Let me grab my John Madden pen here. We actually, a couple of months ago, were out here when it came to actual results. So we're actually doing a little bit better. We'd really like to see that bar shrink to 0 and head towards our 5% objective over time. So you can see that we're short of the target, but we have a strong will, and as Cy is always reminding us, a lot of times the selections that we make are contrarian, and they're very value-based, and sometimes it takes time. So patience and discipline is all part of what we do. On the accuracy part, and again, go ahead, Cy.
I was just going to chime in on that, Mark. Along with accuracy, my own experience with some model portfolios or tracking portfolios, and seems to be the case as well, if I remember correctly, with some of the manifest tracking portfolios, is that we seem to do, that we being the Better Investing Nicholson-based fundamental analysis, tend to outperform the market more in down markets than in up markets. Again, partially because we're somewhat contrarian and we're not strongly momentum-based. My Better Investing magazine column started prior to the 2008 financial crisis and bear market in the latter stages of the bull market before, and tended to underperform for a while until the bear hit, and then I suddenly jumped ahead of the market and have been able to stay there. And my recollection is Solomon and some of the manifest picks had a similar experience. And of course, if you notice, you were saying that we've moved from -6 to -4. What's been happening the last few months? We've been in not really a bear market, but somewhat of a correction. So even on just a short-term basis, that's starting to occur, I think.
That's an excellent point. I really think it's where the quality-centered nature of what we do comes to play. And the other place where it comes, and just as you said, as you come out of one of those corrective moments or bear markets, sometimes the smaller and medium-sized companies lead the way. And
That's right.
We see some of that, obviously, if that does happen. So, yeah, good point. Thank you. On the accuracy, we were down in this range, as I was just mentioning, a month or two ago. So we're actually headed back in the right direction and hope to come in fairly close to the goal that we set. Here's a little bit of a busy look. We're going to spend just a tiny bit of time on this. Some of you have seen this many times over, but again, all it is taking a bunch of portfolios and slapping them on the wall, graphing their experience or their years of operation on the x-axis and their actual performance measured by relative return on the y-axis. So obviously higher is better. At the very top all time is this one up here named Peter. That stands for Peter Lynch, he of the Fidelity Magellan Mutual Fund, where for the 13 years from 1977 through 1990 actually achieved a 13% per year advantage to the market. That's one of the better portfolio management periods that we've seen in the history of investing. So all the red ones are institutional portfolios as shown down here. The blue ones are basically long-term investing community portfolios from all of us around us. I mean, all of us that have been influenced by the NEIC or Better Investing community. Those are the ones shown in blue. That's why we're so tickled to see so many of them in the upper half of this chart. The red ones are basically a bunch of publicly traded mutual funds for the most part, and they rank among the most widely held, and in many cases, some of the most highly successful mutual funds out there. Now, I do want to draw everybody's attention to now, as we said, we're just getting started here, so we're actually at the point with the roundtable where we really don't even care. We really wouldn't even keep score, but we are somewhere down in this range here. But the one that we really like to point out that came out within the last month or two is the research firm called Dalbar, this D-A-L-B-A-R that you see over here. This is actually the data point that talks about the performance achieved by average investors. And by average investors, we mean everything from probably including some day traders to some frenetic traders who call themselves investors or whatever. But for the period 1990 through 2010, you can see that they came in at minus 5% relative return. So if the market did 8% over that time frame, they came in at 3%. The only way you can do that is by chasing performance. You could be unlucky. You could be following hot stock tips. Most of us around here don't do that, and that's why we are so glad to see so many of the clubs that we know and individual portfolios up in that upper echelon of the range. So again, this is where the average investors live, and as long as we can do better than that, we're doing better than a whole lot of people. Here's a look at the round table since inception. This is just looking at the round table. You can see that we've been kind of hovering down around places we don't want to be, but we have been ratcheting up a little bit here of late. And there's an interesting point on here, and this basically represents all of you with your pitchforks and torches. A couple pitchforks in there anyhow. We asked you to vote about 6 months ago, and the stock that you selected that evening was BioReference Labs. That actually has a positive 20% relative return. So we need to get the audience more involved and get you guys in the selection process. So that's why we're going to ask you to vote tonight. That minus 4-point-something% is actually a composite of many numbers, including that audience result from that evening. So again, we want more of this. But a couple of the members here, Ken's one of these here. The other one is a guest knight by the name of Nick Strategos. And our damsels are in this range too. And then we don't need to talk too much about the guys that are down here, but I'm one of them. And we're just holding up the average from the bottom side.
Every house needs a foundation, Mark.
Every house needs a foundation. That's the roof chuckling there that you just heard. All right. Cy or Ken, would either one of you want to go through the portfolio here for a couple slides?
Sure, Mark, I'd be glad to. I like to refer to this as the report card for the portfolio, and you all know that classic better investing methodology suggests that you have a diversity of stocks as far as size is concerned. George Nicholson originally defined size of stocks based on their growth patterns, and he said that a stock that grew at more than 12% he would consider to be a small company. A stock that grew at less than 7% he would consider to be a large company. And in between those two numbers, we're looking at a medium company. It looks like we're in pretty good shape meeting that 25, 50, 25 diversity that better investing suggests and that Mr. Nicholson suggested. We certainly don't want to spend too much time on getting these numbers to be exact, and that graph looks great to me. I'm very pleased with the fact that we have a good chunk of small stocks and a really good chunks of medium-sized stocks as well. I think if anything, we would look at our portfolio and say that our growth is a tad slow, and that means that we might want to boost that growth to maybe 11, 11.5, even 12%. Again, Mr. Nicholson suggested that if the portfolio was growing its sales at 10 to 12%, then you could probably guarantee yourself returns of 14, 15% over periods of time, long periods of time. The rest of the increase coming from PE expansion and from the dividends that might be paid. I'd like to see that growth for our portfolio maybe around 11, 11.5%, but 10.7 is certainly within the acceptable range, as is the financial strength rating of 83 and the EPS stability of 79. I like to aim for 80s in the portfolios that I manage for myself and with my wife. And so I think these are wonderful numbers. Better investing members, as I visit clubs throughout the country and look at portfolios from all over the country, they know quality. And I hardly ever, in fact, I can't remember the last time I saw a better investing portfolio that had a quality rating under 65, which is excellent. Here our quality is at 74, and that's just super. A good solid par, at least 5 points ahead of the market. That 9.3 is either the market closed yesterday or the market closed today. I'm not sure which one, but either number probably will suffice to say that we're at least 5 points better than the potential for the market. We're in that sweet spot of 5 to 10% above my par, and so there's not too much that I really would want to do. If I were giving instructions to a partnership at the beginning of a meeting, the clubs that I belong to, we actually do this. We give ourselves instructions at the beginning of the meeting, and if the only instruction that I would give is don't mess up what you have right now. Don't mess the numbers up, and maybe focus a little tiny bit on growth as you add stocks or add holdings to your portfolio. Is that what you had in mind, Mark?
You bet. Here's a closer look at the top holdings in our tracking portfolio. Again, we don't want to get obsessed with this, but these are the selections that have been made the most often, and basically what we do at the time of any selection is invest $1,000 into the selection. So in the case of Walgreen, you look here and you see $6,500. Well, that's not a single ingestion of 1,000. It's actually 7 of them, and you find that by the key up here, the legend up here. So $7,000 has been invested by us into Walgreen, mostly because Hugh was stuck in a rut, and that's all he could say for 2 or 3 months running. So more on that later. But many of us, I think almost all of us, have a pretty good outlook for the long-term perspective on Walgreens. Take the second one down as another example. BioReference Labs is now up to nearly $5,000. Well, BioReference Labs has been selected 4 times. So you can see that up here. So 4,000 has become almost 5,000. And that's been quite a roller coaster ride, but one that we hung on to despite all kinds of nasty news and stuff out there in the press. But you can basically see from, these are our top 15 or 16 holdings by percent of total assets. And you can see from top to bottom, they're in pretty good shape, other than a couple of playful picks, which we do like to do from time to time. You know, your Southwest Airlines, for example, has a relatively low financial strength and a relatively low earnings per share stability, but 2000 invested in that because it's been featured up here twice. 2000 has become almost 2300. So it is the type of thing where we saw an opportunity, probably a stock that we'd be willing to sell if we had a tremendous gain in it down the road. Anything there that any of you guys see of interest or something that you would want to reinforce for the group tonight?
The only one, and I would just, Ken in the portfolio review process mentioned earnings stability, and I don't know that I ever watched that from a portfolio standard. I do sometimes with individual stocks because I do like relatively straight lines and some stability, but Adobe, what I know of, I think is relatively stable, and I'm wondering if Adobe at only 58 for earnings stability, if that's one of the, for instances, that you do need to be aware of and be careful of putting too much weight on earnings stability without looking at why is Adobe's earnings stability so low for a good reason, that being because it's growing, its growth is accelerating rather quickly. For example, Google, that has a parabolic growth rate. Apple is another. Notice Apple's stability. Actually, I was looking for the lowest one on there, and I thought Adobe was it, but Apple's another. Apple's earnings stability is low, not because it's inconsistent, but because it is accelerating at a tremendous pace. Yeah, so in that case, it might be unstable for a good reason. So be aware of that.
Right, and I think you're basically looking at companies there that do have some cyclical characteristics, and growth cyclicals in these cases, but many times there are outsized opportunities in companies that have any type of cycling behavior. So it's just something to be aware of. I agree. When you hear Ken and I talk about the report card, very often we don't talk a whole lot about the stability as an overall, and you're right to single it out as an individual stock situation. All right, let's kind of close with looking at the stocks at the bottom of the portfolio when sorted from top to bottom by projected return. The return forecasts are the lowest for these companies. And this is the one that we were talking about a little bit in the green room session before. We may come back to this at the end of the night if we have a couple extra minutes. TJX is a company that has been selected only once. So we bought this one for $1,000. It's over doubled since we first put it in the portfolio. And we're actually talking about possibly demonstrating a covered call strategy as an exit strategy or a selling discipline for this type of company. Again, it has the lowest projected return. With the next update, it'll probably still be somewhere in the 5% projected annual return area. So it's the type of thing that we might do. We could even have that same conversation perhaps next month with a company like Logitech. That's even less of a core holding, and it's also down at a projected return less than the median market return. So I don't know what you guys think, but I mean, I don't think there's any direct sells on that list still because of the overall portfolio being fine at 15%.
Yeah, I agree with you, Mark. I might ask you to circle that growth number on TGX as well. I think that a lot of times I would put a stock like TGX in a portfolio because I expected it to grow at a pretty quick rate, and it looks like the growth in the company is maybe slowing down a little bit right with the par value as well. I can see a couple of reasons why I might want to investigate some experimentation. That's a really tentative way of saying I'm scared stiff about these option things, but I'd love to learn more about them. You know?
Well, and that one's your pick, so I mean the covered call, when it works out, can only improve the overall performance of that single position, so pretty cool stuff. All right, if there aren't any other comments, let's go ahead and move on and launch into our stock selections for this evening. And Cy's going to kick us off with the home team in the Ducks down in Atlanta.
All right. right, Quack Quack from Atlanta. My pick tonight is Aflac. I think this is now the third time that Aflac has been selected for the portfolio. You can see here relatively up and relatively straight and parallel lines for historical sales and earnings. I will point out that Aflac, being a financial company, the line that is marked S is actually a plot of book value. And then when we talk about profit margin, as we will later on, we'll be talking about return on equity, which is, as Mark is indicating there, showing the distance between the two lines. So that's just a slight little tweak that we do with the manifest analysis of financial companies. All right, let's. Oh, I will point out too. I use this as a screening tool when I look at a thing, that being value lines low, total return for Aflac, which is 14. That's actually a fairly old report. I believe it's April the 13th, if I recall correctly. It's in April. Will be updated before too long. And also notice the price. The price is 45, and it's running down around, I think, what it close at, 36 or so today, Mark? 38? Somewhere in that range.
I'll look it up. Well, it's going to show up on
well, it'll show up in a minute because
41.
Yeah. Okay. Actually, I think today that's yesterday's price because the price changed as I was doing my slides. I think that's yesterday's close, but 41. It's still down a little bit. You can see here the way I chose Aflac tonight. I thought that I would look at accumulating more of an existing holding from the Hoard portfolio. This is simply an excerpt from the Hoard dashboard ranked by total return. You can see ABB Limited was the bottom of the yellow or the maybe range. They're at 19.6, and then I gave you again another chunk of some of the green stocks, that being in the sweet spot of between 5 and 10 points above my par. Aflac came in right at the top of the sweet spot, and so I said, let's take a look at Aflac a little bit and see if it's what I want to pick tonight. Next slide.
Yeah, by the way, it did close at $39.67 tonight, Si, so it's underneath, just barely underneath $40.
Okay. Here is what I like to take a look at as an industry study, and I've given you a couple of a broken bit of a slide. If you just pretend that the edges aren't there, that being the torn bottoms aren't there, this would be what you would see if you click on an industry link at Manifest, that being the companies in the industry, and then running down the vertical axis and then horizontal being the various characteristics. The reason these are broken up is what I did was do various sorts and then just condensed it into one slide rather than 4 slides. You can see the first one shows that in the life insurance industry, Aflac has the highest quality at 76.2. Then the next area that I sorted by was net margin, and it has the second highest net margin. I then sorted by growth, which again, remember for financial stocks, that's actually return on equity, has the highest return on equity or growth rate. I'm sorry, not return on equity, growth in book value rate. Now, the net margin was the return on equity. Thank you for sticking that up there, Mark. And then that growth is a growth in book value. And then just taking a look at the yield, and you can see that Aflac does fall in about the upper third, actually, if you saw the whole chart, but it's near the top in projected yield. Not a huge factor in my pick, but again, you get, given the very low interest rates right now, it's not bad to have a little bit of a dividend yield to reward you while you patiently wait for the market to run to your stock and drive it up in price. Next slide. This is the Eagle on Aflac, and it's basically, I thought that all of the default manifest selections were pretty much in line, and I only changed one, which I'll point out in just a second. But you see the three judgments, the annual growth rate of book value, then the return on equity, or as shown on other slides, a profit margin. That is the one that I did change, and I'll mention why I did in just a minute. And then the PE forecast, which is 10, all leading with those three judgments to a projected annual return of 18.2%. The one change that I did make was return on equity. I lowered that a little bit from the 18.3 or so percent that was at manifest, and the reason particularly was, as you can see on the slide that is, or the graph that's next to that area, you can see the history over the last 9 years, and you see that it's been going up every year, which certainly we like to see, but even good companies tend to follow a little bit of a cycle in profitability, so I just essentially chose the midpoint, which happens to be roughly about where it is right now, as you can see, over the last trailing 4 months. And so I chose that to be a little more conservative and just lower it to 17.1. But essentially, I found the manifest selections very reasonable. And also, I stuck up here the PE selection, which I left at 10 because financial stocks are pretty beaten up, and that is pretty much the PE for the last 3 years, as you could see from that chart for Aflac. But notice the first half of, really a little over the first half of the 2000 decade, you can see that Aflac was running in the high teens, up as high as a few times to 20. So I think there's certainly still some potential that we may see higher than a 10, but I was comfortable with 10, particularly given the PE ratio right now being down just below 8. So I decided to go with Aflac tonight, and from a subjective standpoint, much of what has beaten Aflac up is the same thing that's hit most financial companies, that being credit or loan portfolio. The vast majority of Aflac's bond portfolio now, I believe it's 90% according to Value Line, is now investment grade, so they have very little low quality investments in their portfolio, and they have been taking charges the last 3 years or so, which has tended to hurt their earnings, but it appears that they're pretty much through with that process of taking charges, and Value Line at least projects, as does the company, that the earnings will significantly improve over the next several years. And so I think we could see some outsized gains with the duck from Georgia.
Okay. Well, thanks, Si. So that'll make a 3-time selection for Aflac, and I do think you capture a very important theme. In fact, it's one that Hugh is probably counting on, that the depressed or suppressed return on equity levels are nowhere near what they were in the past. And even if they don't go to what they were in the past, we think many of the financial sector companies will probably show some recovery characteristics, hopefully in the future, for those of us that continue to hold some of the financial sector leaders.
Mark, we're getting a question from Dan. Dan would like to know if if Aflac has been able to rid itself of most of their remaining European sovereign debt.
I can't answer that from the perspective of totally knowing what's still held on their balance sheet, but I do know that they have generally written that down through way of impairment charges to the point that they do not consider their risk significant there any longer. So kind of a long way of saying the any potential future problems with the sovereign debt should not impact Aflac because they have either successfully sold all of that or they have written it down to essentially zero.
Okay, anything else, Ken?
No, that brings the questions up to date for the moment.
Okay, so with that, let's go ahead and transition out west to our friend in the green hat. Take it away, Hugh.
Well, thank you. I was really tempted to add Walgreen again, but I thought, you know, why not Staples this time? I actually often look at the 52-week low price, and I'm usually kind of seduced if the price is low. I like all of us here, we're long-term investors. So it doesn't really concern me if a Walgreen or a Staples doesn't turn around in the next few weeks, months, or for me, in my case, at least even years. It's building a portfolio, and companies like Staples or Bank of America or whatever are kind of adding ballast to that portfolio, a bit of stability in the long run. So I just like to add companies when I see they're at a good price and the fundamentals are either improving or looking good or even improving. I just like to add them in there. And in the case of Staples, I think the fundamentals are showing something very positive, something that is looking better, but in the short run not. So let's take a peek at Staples. And the next slides, the next few slides actually, are culled directly from the company's website, from their fact sheet. This really just shows today's closing price. I updated this slide today. It's very near the 52-week low. You can see about the fifth line down where it's $11.49. It's an $8 billion company. It's a big animal, but it has a very low PE ratio of close to 9. And quite a few shares outstanding. I'll comment on those later. The comment I will make, actually, if I remember, is the fact that they are buying back shares, which helps people like you and me if we own shares in this company. And you can see from the chart that it's low as well. The earnings projections have been moderated, the future earnings, say for January 2014, and that's really got to do with the economic climate that we're all living in. Things are not as rosy as people had expected, and the business environment looks like it might stumble along for the next few years. Certainly the Fed has indicated they're not going to raise interest rates. People like me and you that collect shares for a hobby, this is a good thing, because for the next 2 years we will be able to buy companies, let's hope, on the cheap. Makes the portfolio look horrible, but at least the portfolio will get a lot of nice new friends that were purchased at a discount. And then if we look on the next slide, one of the, I guess, things that a lot of us don't like is the fact that almost 94% of the shares are owned by mutual funds and institutions, a huge number, 1.6 owned by insiders. And, you know, in fairness, I guess mutual funds represent people like you and me in 401ks, at least I would hope so. So there is nowadays, as I think Dan Hess wisely pointed out in a comment on Manifest Investing, an indirect way in which individuals own shares nowadays in different companies. And then if we flip to the next slide, again taken from their tear sheet, just a summary of the financial condition of the company, we can see as of the end of the first quarter of the year who owns what. And we can see that there's really heavyweight companies that own quite a large chunk of Staples. If we go to the next slide and look at recent news, it has had a weaker than expected quarter, but it is still expecting low double-digit growth this year, and it expects the bulk of that to occur in the second half of the year. It talks about things like Windows 8 and so forth, but it is hoping that things will improve. Margins seem to be flat at the moment, and they don't look like they're going to improve in this business climate, and the company has openly expressed the fact that it is facing challenges in Europe. But it is the 800-pound gorilla, so its competitors are in the same boat. It has wisely reduced the number of new stores that it's opening, and in fact it's even closing underperforming stores as the leases draw to a close. The only two exceptions to store openings turn out to be in growing markets like Brazil and China, so there are no surprises there. And it continues to buy back shares, mentioned that earlier. It has a very strong balance sheet, and analysts constantly chatter on about the possibility of it merging with another entity, an Office Max or an Office Depot. I thought that was tried in the past and was turned on, but of course the regulatory environment changes all the time, so who knows what could occur there. But in the next few slides, we'll talk about some of the secrets about this company, which are kind of fascinating. It's a behemoth. It's a $25 billion company. It claims it invented the office superstore concept in '86. Of course, we all know that it probably just copied Toys R Us or something like that. But it is truly a behemoth with almost 90,000 employees. The bulk of its customers are business, 80%, with only 20% consumers like you and me who walk into the retail store. But it still gets about 40% of its revenues from traditional retail stores. The rest is delivery, and this is the real gem in this company, is its delivery service, because as it finds brand new markets to service companies, one of the things that it has discussed in the last few quarterly calls is not quite office supplies, I'm drawing a blank on the name, but it's ancillary kind of services into kitchens and break room supplies, coffees, etc. It's doing phenomenally well in that area. It's a very fast growing area for the company. So we skip to the next slide. The bulk of its revenues, 40%, come from North America through contracts and servicing businesses. It has Staples.com, and it bought Quill.com a few years ago. And for those of you who are fans of The Office, Quill, a subsidiary of The Office being a TV show on NBC, Quill, which is a subsidiary of Staples, wholly owned subsidiary, has signed a deal with NBC and licensed the rights to the words Dunder Mifflin Paper Company. And so in offices around the country in the next few months, you probably will start to see Dunder Mifflin office supplies show up in your companies. It has over 1,900 stores in North America. Average size is 2,200 square feet with 9,000 separate distinct products. And 40% of the company's sales, global sales, come from these stores. On the next slide, you can see that 20% of sales come from international offerings. This is where the real expansion is happening. And with only 376 stores in 11 countries, that's a big chunk of business. But it does a lot of its business through delivery. But international expansion is where this company, I believe, will grow, and probably grow quite dramatically, following a McDonald's or a Yum or a KFC model in the future. There's a lot of upside overseas. On the next slide, some little surprises about Staples. Staples is the #2 electronic retailer in the world, right behind Amazon.com. It gets $11 billion of its revenue online. And it has over $250 million electronic transactions per year. It's a big deal. It serves almost 2/3, 60% actually, the Fortune 100 companies, and 200,000 mid-market companies. And these are companies that are large, with 5,000 or so employees. It can offer next-day delivery services through UPS or through its fleet of 1,500 trucks to the vast majority of addresses in North America. And it is actually the largest retailer of ink and paper in North America. It constantly boasts about that on every conference call. And it has a very active recycling program as well, as I think any of us who buy cartridges at a Staples store get to know. If we move on to the next slide, I looked at Value Line to see what they had to say about the company. Its timeless and safety look pretty good. I've never figured out what the technical feature means, but its beta, it hovers nicely around the market. But its annual return projected return is quite good, quite nice and healthy. The next slide, we see a projection of where they think the sales will be, and they have a very low number. I think it's too low. You can see in the bottom box there where it projects sales from 2015 to 17 to grow at only 3.5%. I've chosen a number slightly bigger, 6% when I did a stock selection guide, but lower, of course, than what it has done in the past. And it will be sluggish for a while, but the fact of the matter is that when you're in a hostile environment like this, a tough business environment, it puts more stress on companies that don't have economies of scale, and inevitably the big, efficient companies are the ones that tend to do the best and tend to come out at the other end stronger, tougher, leaner, etc. And that's what I'm banking on for a company like Staples. Moving on to the next slide, I think we just look at the stock selection guide. Not perfect by any stretch of the imagination. There clearly is a cyclical component to its earnings. Its sales are growing nice and steadily. I projected the top line to grow at 6%, and which is lower than it has grown on average. But if we go on to the next slide, we can see that its return on equity and its pre-tax profits and sales are about even with what it's done in the last 5 years, maybe even up slightly on the last few years, which you would expect as we slowly come out of this Great Recession. And then on the next slide, we can see part 3 of the stock selection guide, just looking at the PE ratio. Pays a little bit of a dividend, and it has a payout ratio of close to 30%, certainly over a quarter. I actually chose as the high and the low PE 20 and 10 respectively. Maybe the high PE is a little bit high compared to where it was last year, but the fact is that over time, the high PE ratio historically for this company has been over 20. So I still think I'm being a little bit conservative here, but even if I had throttled back, if we go on to the next slide, Staples would still have ended up as a buy for its current price, which is just a few percentage points from its 52-week low. It's a pretty healthy upside-downside ratio there of 7 to 1. And I chose a low price of 9. I'd be surprised if it gets there, but who knows. But still, I think it looks pretty healthy in this analysis. And we bounce to the final slide, part 5. We can see the compounded projected average total return is about 18%. And that compares quite favorably with what turns out to be the more conservative analysis on the next slide, manifest investing, where we have a projected average return of 14.9%. Quite healthy there. We have a nice EPS stability of 94%. That's for you, Si. I know how much you love that. And I think all in all, it has a nice projected average return, annual return, excuse me, of 16% and change, and it's a high quality company at 85.2. And then if we look at, just to complete the analysis, we see where the PAR has been going for the last number of years, and the quality of the company has actually been improving slightly over time. All very nice. And the motley fool that I figured have never met a company that they don't like has the bulk of people saying that it will outperform, including the all-stars. I would love to find a company. I'm sure they exist. Maybe this is just my problem because I'm always looking at quality companies. I'd love to find one where 95% of people think this company's a dud.
There's a couple of them out there.
I'm sure they must be there. Well, of course, no one would bother following them, you know. So, in summary, it's had a rough few quarters. I love that. I love bad news happening to good, solid, stable companies. It's digesting another purchase at the moment. It's trying to get things sorted out in Australia. It's moving some of its key people there to figure things out. As you can see from this analysis delving into the company, annual report is a nice read. It is the 800-pound gorilla. It has kind of hidden assets that you seem to don't realize about it. It's expanding where the growth is. It's expanding overseas, and it will benefit as the economy gradually recovers. So, I said I would select Walgreen to Mark earlier, but I changed my mind, and I'm going to select Staples.
Yeah, you were stuck in that rut.
Love Walgreen. It's a great time to buy. But I get to only pick one.
All right. Well, thank you very much, Hugh. And again, that is another repeat selection, probably a third-time selection. Yeah. Ken, do we show any questions at this point, or should we kick anything around at this point?
No, we're doing fine, Mark, if you want to keep moving.
All right. So we now go into my disclosure of my cheating ways. Actually, Ken turned in his homework first, and he told us that he was selecting FOSL this month. We normally try to avoid duplicating our selections. You know, we make the selections fairly close to the time of the meeting. But as I cranked through some stuff this weekend and earlier today, I found myself ending up in the same place as Ken. Now, there's many ways you could look at this. Mark was lazy and didn't do his homework this weekend. That's one possibility. Another possibility is I'm tired of holding up the foundation here of all of our selections, and I'm just simply jumping on the leader bandwagon and hoping that my results will average up. But there's several things that you can do here. But FOSL, and let me give you the true bottom line. Well, it says right there, fostering creativity and delivering the best in design. That's one of their mottos. For those of you who are not familiar with the company, it's a company that has been around for several years. It went public in 1993. And they basically make some pretty cool watches, some baggage type materials, and then also a line of apparel, and all of those are shown there. Pretty capable company. But the reason that I ended up selecting it is actually much less innocent. What I basically did is I took a screen at Manifest Investing, and I looked for the top 1% of all companies by screening on Manifest rank greater than 99. And then what I'm basically going to demonstrate here and hand off to Ken Kavula for the fundamentals, I'm going to share some of the technical aspects of the company, including some of the momentum and sentiment indicators that I look at. But the bottom line is when I took the screening results at Manifest and I subjected that to an additional screening or filtering process where I said I only want to look at the companies that are in a bullish trend. And that's basically paying attention to the behavior of the herd of rhinos or the institutional analysts or the big money. So again, the smart money is bullish on this company along with the others that you see on the screen. Could have picked several of these, but I didn't want to go for the fracking this month. Figured that would be a recipe for disaster. Here's a couple more companies that I just backed away from. So again, FOSL ended up at the top of my list, not only from a fundamental aspect, which is what Ken is going to cover, but also from the technical aspect of a few things that we'll talk about here for a few minutes, setting up Ken to finish us off. Can't escape some of the fundamentals. This is an illustration of a company, FOSL, where the value line sheet is not that old. It's a couple months old, but you can see that the stock price is dropped from 126 all the way down. In fact, it got up very close to 140. It's dropped all the way down to $73, rendering this number over here dated. And in fact, if you basically crank out the calculation, continuing to use a low price forecast of $140 a share, using that new price in the 70s, you get a low total return forecast of not 3%, but 17%. So again, when we tell you to look at this low total return forecasted value line, just be cognizant of the fact that if there is a huge shift in price, that is a date stamp. It's a moment in time, a stake in the ground, and you do have to account for the differences up on the top line. So if you're using the black value line book for screening and you're just literally paging through the pages, be aware that this is a condition that you can run into. And again, correct for the difference or the shift in the current stock price. Here's a stockcharts.com look at the long-term price stock chart for FOSL, and we just want to key in on a couple of things. By the way, those of you that checked out the forum this morning know that I wrote about how the stock market is a teenage daughter, so you can go check that out. That's Martina McBride that you see there. Yeah, we went to see her this weekend. But a couple of things that we want to point out. When it comes to momentum, one of the leading indicators of momentum, one of the devices that you can use to gauge whether the companies are overbought or oversold, is what's called the Relative Strength Index, or RSI, by stockcharts.com. And in the case of FOSL, you can see that it actually got down below 30, which is where a company is most potentially oversold, fairly recently on that huge price drop that you see here on the right-hand side of the screen. It literally dropped from 140-ish down to 70-something literally overnight. So that's quite a haircut for a company like this. And you obviously want to dig in and look for even more powerful reasons. Ken and I have raked this thing over the coals. He's going to share a few more sources with you, but this is truly a situation where at least this segment of the market is behaving like a teenage daughter. One last point on this slide is, one of the reasons for that price drop that you see there is the number of people who expect the next recession. The next recession to be deep and not too far down the road. And one of the reasons that we included this graphic here is to just emphasize what can happen to a company like FOSL in the middle of a correction or a deep recession. In the case of the Great Recession back in 2008-2009, you can see a fairly considerable price drop from the advent of that recession all the way down here. So again, this is the type of vulnerability you have with a company like FOSL, and you never want to forget that. It's one of the reasons that you probably want to demand a premium. You want a higher projected return or return forecast when you go into a company like FOSL. Probably stealing a little bit of Ken's thunder here, but I went looking for reasons for that carnage or that damage, and frankly, I didn't find much. Here are the return forecasts for FOSL for the next year, the end of this year and next. They did not get dinged too badly. Obviously, if you're a current shareholder or a potential shareholder of this company, this is something you want to watch fairly closely to see if the rhinos do project any weakness when it comes to the top line sales. Notice that their growth forecasts are going to line up pretty closely with our our visual analysis. I'd be surprised if Ken was using a number dramatically different from either of those two numbers. And the other thing that you see here is over the last quarter, yeah, there was quite a hit. A company that was projected to do 550 is now down to 530. That's actually not that bad. And for the year-end 2012, from 664 down to 621, I for the life of me, I can't figure out where a 40 or 50% drop in price would grow out of something like that. So kind of wrapping things up a little bit here, our point of view summary on the company FOSL, we basically see a company that does have an elevated return forecast somewhere around 20% based on today's price of $73.50. We see an extremely high quality company. It's among the best at 88.3. That's actually probably in the top couple percent of all companies. It's got a strong financial strength rating. Their effective interest rate is less than 5. We see a company growing, and again, when we say we, we're talking about the analyst consensus here. Companies like Value Line, Standard & Poor's, Morningstar, etc. We see a mid-teens growth forecast for the company with a very strong net profit margin, profitability over time. Again, mid-teens valuation for the company, and right now it ranks in the top of the ranking at Manifest Investing, and we'd consider it to be a relatively strong buy. Just to do a little bit of cross-checking, again, that price-corrected low total return forecast is around 17. You can see that S&P, both S&P and Morningstar have a little bit different outlook on the financial strength of the company, but you can see fairly comparable growth rates at Value Line. And by the way, this is the global breakdown. The first number is the United States, the second is Europe, and the third is Asia for Standard & Poor's, and it basically adds up to something fairly close to our number. Again, profitability, pretty much in agreement there. The PEs are basically in agreement, but Standard & Poor's does see this company as a whole. Now, when it comes to Standard & Poor's and when they're weighing in on opinions on companies, one of the places that I pay the most attention to them is they're better than average. They're among the best when it comes to companies that have cyclical tendencies. So in this case, you know, if I'm shopping for my own portfolio, thinking about spending real dollars, the fact that these guys are a little bit chilly on FOSL is not something that goes unnoticed by me. So this hold is something that I do take seriously and will continue to dig. But again, I've been unable to unearth anything that really rocks my world, and I still consider it to be a pretty good situation and just hope that Standard & Poor's is wrong. Momentum-wise, pretty good situation here, down around 40. They're closer to oversold than overbought. As I said, they do have a bullish price sentiment. We'll take a look at where that comes from here in a second. And again, like Hugh said, the Motley Fool community, it seems like they never met a company they didn't like. By the way, this is kind of an average number, and just what Hugh said. That's kind of an average number. And the average company at the Motley Fool for the All-Star Pickers is somewhere around 93 or 94%. But it's still not bad, so sentiment is actually fairly strong. Just wanted to give you one last slide to chew on. Again, this is from stockcharts.com. It's what's known as a point and figure chart. By the way, for those of you that are shivering and shuddering out there, Better Investing had these on the pages of the magazine for nearly 2 decades. So it's something that many of you out there have seen before and many of you use. And we're actually doing some anecdotal and empirical research at Manifest to try to figure out how meaningful this stuff is. And for now, I just want everybody to focus in on the fact that there's a herd of investors out there that follow the company using techniques similar to this that are bullish at that new price level. And in fact, they see a price as somewhere around 90 as something fairly achievable target. So again, bullish sentiment, very powerful fundamental considerations, some decent momentum. Could be oversold, could bounce a little bit, could stagnate for a while, but this is a fairly high quality company that, absent a deeper recession, should actually hold out and fare pretty well. So with that, I'm going to go ahead and turn it over to Ken, and I wish I could say he was copying my work, but you know the truth, and let him give you a little bit of a rundown on the fundamental and traditional fundamental analysis. So take it away, Ken.
Okay, Mark, you want to switch the screen to me?
Okay. I can do that.
Yeah, and of course it comes up on my Zhang pin, which I didn't want it to come up on. Here we go, FOSL. I'm going to start by presenting a fairly straightforward stock selection guide on FOSL. I've been looking seriously at FOSL since that price drop. Two of the clubs that I belong to did a study on specialty retailers, and both of the clubs did these studies independently and brought the industry down to a couple of companies that I found very compelling and very interesting on top of that. They brought that industry down to Coach, FOSL, and a company called Michael Kors with a very limited amount of trading history behind Michael Kors. But when FOSL came out, I didn't know too much about the company. I knew that there was one of these stores up in an outlet mall close to where I live, but other than that, I didn't know very much about it at all, so I began to dig into it, and I started with this SSG. One of the clubs actually owns this stock right now, bought it after the price drop, so don't feel sorry for us. We didn't take the big price drop or anything, but notice that it has a fairly small amount of debt that it has to deal with, and this is the results of the last quarter that were actually a little bit better in earnings than a lot of people had anticipated, but fell short in the revenue end of what was going on. And then I think what really sealed the deal for FOSL was the fact that their predictions going forward, some of their guidance, as you will, going forward was a little bit weaker than the analysts thought it needed to be. So here I am looking at that first quarter, and I'm not too worried with growth right here, although it's not meeting my expectations in that quarter. I am looking at lines that I figure to be reasonably straight and reasonably up and reasonably parallel. There is some cyclical nature perhaps to the earnings, and it took a little bit of time to come out of the recession. I noted that earnings kind of stalled there for a little bit during the recession. Sales maybe even went down a little bit during the recession, but then we came roaring out of the recession in a really strong manner here. I've estimated growth going forward at about 15%, and once I estimated that sales growth at 15%, which by the way put me very, very close to the value line number that Mark brought forward just a little bit ago. I think the value line number is 5,100 millions, 5,100 thousands right up here, 5,100. So I'm very, very close. Once I decided on the growth rate of 15, I did go into the preferred procedure, and the only place that I chose to make a change from the defaults was I chose on the margins right here to up them just a little bit, the pre-tax profit margins. The average had been 15.2, and the last couple of years the margins have been significantly higher than that, so I moved that margin up a little bit to 17. That gave me a revenue estimate or a preferred procedure EPS estimate of 15.1. In other words, earnings were following sales pretty closely, and that's the numbers that I used. I'm fairly happy with the net profit margins, which seem to be in the past year beating the 5-year average, and the return on equity is great. Return on equity at this level is difficult for a company to put together, and I noticed that it's significantly higher than most of the recent history for the last couple of years. I'm looking at PEs, and while FOSL's trading at a lower PE than most of the high PEs in the past 5 years, it does appear to be trading right now at about its average. And in fact, when I looked at these numbers and did a little comparison with various sources and everything, I decided that I could live with these averages from Section 3 in Section 4 of the Stock Selection Guide. I did adjust my trailing 4 quarters to $4.68 and then chose a low price of $42.60, giving me a pretty decent upside-downside ratio of 4-to-1 and a return of around 14. Now you'll notice if I go to manifest And if I get on FOSL rather than Zhongping, and I don't know why I'm on Zhongping.
I think you're being haunted.
It must be, well, I'll tell you what I was actually doing as an aside. Hugh wanted to know, was there a CAPC one where everybody thought it was going to be bad, and I thought maybe Zhongping was it. So I went to look. It had a really high CAPC as well. Okay, here's FOSL.
I was thinking, Ken, that you had done a switch like Hugh and Jean-Pan was your pick, and you changed
no,
to FOSL.
No. I'm not going to fall for that twice, Si, okay? Here's the FOSL, and Manifest is a little bit more exuberant than my SSG is. They're showing a par value of about 20%, certainly in the same ballpark as my 14-15%. Very, very high quality rating from the company. I use Manifest in a lot of different ways, and one way is when I'm beginning to do work on an SSG, I would like some verification, some reassurance that my numbers are in the same general place as somebody else's. So Mark's number of 22 certainly gives me that kind of reassurance. I notice over on the side over here that Manifest gives me, if I can get my cursor to work, there we go. Manifest gives me the tops in the retail specialty industry, and there's those two companies that have come out consistently at the top of industry studies that I do, Coach and FOSL. And in the sector, Coach and FOSL also seem to be coming out near the top. That's the consumer discretionary sector, or just plain old discretionary. I then went to do a little bit of research on the company itself. It operates in two divisions. It operates in a wholesale division, which represents about 3/4 of its business, and the other quarter is a direct-to-consumer business, most of which is in e-tailing. It's not in a retail store like the outlet store that I'm familiar with, but about 85% of that 25% is in direct sales to customers through the internet. I looked at what was happening in the wholesale segment, and a lot of the press when FOSL came out cited Europe as a reason why they were downgrading FOSL, or why they thought FOSL would be having problems going forward. But the history, the recent history showed that the European segment of the company was extremely stable. In fact, it actually grew a little bit in the last quarter, and the company seems to think that its European segment is going to stay stable as well. You compare that to what's happening in its Asian segment, where it grew its store count at about a rate of 35%, and it now has Asian sales accounting for about 12% of the wholesale segment, and it hopes to double that number in the next 3 years. The United States sales are robust and growing at double digits, low double digits, 10, 11, 12%. So I'm fairly at odds with myself in trying to figure out how Europe plays a part in this huge drop. And I'm wondering, like Mark, where the market's going, and anybody that would like to argue with me about a rational market, I'll take you on, and we'll sit down and we'll talk about how rational this market has been recently. FOSL just completed a huge acquisition of a company called Skagen Designs, and again, I'm not familiar with the goods per se, but this is a big company out of Scandinavia, with a large presence in Denmark, Germany, and Great Britain, as well as in Hong Kong. I was interested to find out that FOSL not only has a lot of its own brands that it sells directly, but it also licenses a lot of brands. So when you buy a Burberry watch, for example, or when you buy many Burberry accessories, you're actually buying things that are manufactured by FOSL. DKNY, that's Donna Karan, New York. That brand is also licensed to FOSL, and FOSL is the one manufacturing some of the jewelry and the watches and the accessories under that brand name. Armani is another brand name that FOSL has that it licenses and uses quite a bit.
Ken, you mentioned Michael Kors earlier as one of the other companies that was attractive as a standalone. I'm 99% sure that Michael Kors is also represented by FOSL.
That could be, Mark. I didn't find that, but that could very well be. I'm looking at Value Line. I'm looking at my other sources that I typically use. Mark was right. Morningstar has kind of chickened out on this particular company. I don't find very much in Morningstar. But all in all, my SSG is telling me that this is a reasonable company to take a look at. And so I'm going to add it to our portfolio, hoping that I'm finding it near the bottom of its cyclical earnings per share and that I can ride it up. It certainly is not something I would consider as a core holding, but it certainly is an interesting company that might be able to make me a few dollars in the next couple of years.
Thanks, Ken. All right. Were you able to put together a poll for us, Ken, or do we have that for the audience?
If you give me just a chance, Mark,
give you a chance to catch up with that.
I'll launch that poll if you give me just one moment here. And don't do this very often, so let's see if I can make this work.
And while Ken is juggling around with that, he's actually got the poll open already.
Okay, and Mark, because Hugh mentioned Walgreens, I decided to put Walgreens on the poll as well. So, folks, you have a chance to vote now on which one of the stocks that were presented might be something that you'd want to invest in. And if you think Hugh should have picked Walgreens, then put your vote in for that as well.
I'm pretty sure if you vote for Walgreens, Hugh's going to send you a Christmas card.
Okay. All right. We have half the folks voting. All you have to do is use your cursor and press one of the choices on your screen. You don't have to do anything fancy. Now we're up to 3/4 of the audience voting. We'll give you just another couple seconds. We're up to 80%. If you haven't voted, why not just choose one of those companies right now? There's no campaigning sign. No campaigning. Okay. All right.
How many times are people from Chicago allowed to vote? Did we decide?
All right. I'm going to look at the clock here and count down 10 seconds. We have 85% voting. Last chance, folks. Okay, I'm going to close the poll.
I want to know what Ann Manning voted for.
And I'm going to share the poll. Now, Mark, I can't see any of this on my screen, so are you seeing the poll on your screen now?
I am seeing the polling results, and 9% of the attendees checked in with Walgreen. So Hugh, you've got some colleagues out there. 17% on Staples, 31% on Aflac, and 42% on FOSL. So we're going to have a 3-time selection as an opening position in FOSL, because we will track this as a selection made by myself, Ken, and the entire audience to go with your other pick of Bauer Reference Labs a few months ago, and may they all work out equally well.
Okay, now, Mark, let's see if the screens look correct when I do what I'm doing. We should be back to, we're hiding. Are we hiding did we hide now?
Go ahead and just switch it back to me, I guess, Ken.
I got to get you on a screen now. Okay, I pressed one of the wrong buttons, but
I got me.
All in all, for the first time, I think I did it okay.
You did great.
Here we go. Okay, we're back to your screen, I think, Mark.
I think we're back to me. And with that, we're going to stick around. We are coming in under our 9:45 end time, but what we will do is stick around for a few minutes if anybody has any questions. And then, as promised, for those of you that would like to stick around for a discussion of using a covered call as a selling mechanism to trim positions within portfolios, we're going to probably spend 3 to 5 minutes on that. He's going to actually show us how to dig into that, and we're going to experiment with that for the roundtable portfolio.
Okay, Mark has a slide up right now about the 61st Annual Better Investing National Convention in Houston. All 4 of us are going to be in Houston. We'll be talking at roundtables. We'll be speaking at No Holds Barred Let's Talk Stock sessions. We all have some formal classes we'll be teaching as well. So if you get a chance anywhere, if you're anywhere near Houston on September 13th through 16th, or on any of the single days during that time, come on down to the convention. The day rate is very reasonable, and you can attend 4 or 5 classes for a day rate on Friday or on Saturday. Saturday is a free day where you can come in and visit with many, many companies in our expo hall, as well as meet our teachers and have a couple of lively panel discussions and presentations going on. So if you're anywhere near Houston in these days, come and join us, say hi. We're going to have a great time, and we'd love to meet some of you there and have a talk. Mark, I have a few questions. Do you want me to clear them now or wait till the end of the session to clear some of these?
Let's go ahead and take care of the attendees first, and again, anybody who wants to stick around can.
Irene would like to know if the tsunami in Japan will have any major effect on Aflac's overall earnings.
I have seen nothing to indicate that it would, nor can I really think of a strong reason that it would. The best way for me to answer that, outside of just that general knowledge, is that Aflac, since the tsunami has occurred, has generally done quite well in Japan. So apparently it did not have an impact on Aflac.
Thank you, Cy. Rob Stevens is giving a testimonial for Skagen watches. He says they're wonderful. He owns several, and all of his family owns them as well. So there's a gold star for Skagen, and that's now owned by FOSL. Geraldine would like to know, what's a core holding? I referred to FOSL as being something that I would not consider a core holding in my portfolio. Geraldine, a core holding is something that I plan to hold for a significant period of time, forms the basis of my portfolio, and FOSL is something that, while I'm looking at it right now, I wouldn't be loath to trade it away if I found something that I considered more interesting with a greater potential. A core holding is something that I plan on holding 2, 3, 4 years, maybe longer if the potential stays there, but it's not something that I'm buying with the intent of holding for extremely long periods of time. Dan is making a comment for Cy. A friend of mine in Japan indicated cancer insurance has picked up since the tsunami nuclear incident, and that would be a plus for Aflac, Cy, correct?
That certainly would, and actually when I made my statement about I didn't think of a logical reason that it, a logical connection, I was thinking of the water and had actually forgotten about the radioactivity scare, which I can see how that might be good for Aflac. So thanks for bringing that out, Dan.
Okay, and Mark, that's all of the direct questions right now. If you'd like to move into a brief discussion about covered calls, maybe we can use TJX as an example, and I'm willing to do whatever formal we need to do to put it on the table and to write that covered call after we talk about it a little bit.
Okay, well, thanks, Ken. Yeah, here again is the ranking by return forecast or projected annual return for the portfolio. So we're talking about probably the most successful selection that we've had for 2 years. So again, we're talking about dealing with a position that has been a significant winner for us, but has clearly gone up quite a bit. So I think what we'll do is let's go ahead and take a look at the stock charts picture for TJX just to make a point as to how strong this gain has been, again, coming out of the Great Recession, and then perhaps you can walk us through the possibility of a covered call here. You can see that this is a company that's got some a seriously strong trend going back for a couple of years, but that it has actually been fairly recently, when it got up into the low 40s, what could be deemed as potentially overbought. So overbought, which means that there's basically been a little bit of a frenzy, If you go back to early 2010, you can see the last time when that condition presented itself. And again, a relative strength index, or RSI, greater than 70 is potentially overbought. And the way that we think of this, especially for a company in a situation like this, is you probably wouldn't do anything with that other than to recognize that you might have either a stagnation of price, which we saw here in the 2010 time frame, or a decline or a drop in price following one of these, it's kind of like a hyperactive or frenzied moments. So we're actually fairly close to one of those right now. That's another log on the fire for, perhaps putting in a condition where we would sell somewhere slightly above this situation with a covered call. So with that, Hugh, do you want to guide me through if I go to Finance Yahoo perhaps?
Sure.
Okay, so let's go to TJX.
The first issue, and we'll have to make an allowance for ourselves, because I think there are 43 point something shares in the portfolio.
Oh yeah, we're going to have to make a procedural allowance and basically have a half a contract or something like that.
Yeah, because contracts are written for 100 shares.
So much like any model portfolio, this is just a tracking portfolio, so we will have to make that amendment. Mm-hmm. You couldn't actually do this precisely, and that would be different if we had 100 shares, but we don't.
And a call, or a put for that matter, but we're going to look at call. It's a contract between two parties. One party pays the other, and in exchange surrenders a right. So one party has the right to buy shares at a prescribed price, and the other has the obligation to sell those shares if so requested. So if we look here at TJX, it's currently trading at $42.40, and when you click on that button called Options, it will list all of the option contracts that involve TJX, and it lists the calls first and the puts. But I think we're going to focus here on the call options. And there's a number of distinguishing features about an option contract. There's a strike price, and we can see those listed over on the left. That's the price at which the transaction would occur. And there's an expiration date, and contracts are written to expire generally once monthly, but there's a new phenomenon called weeklies as well, and there are now almost 200 of those types of contracts. But these options are written to expire in either July, August, October, or the long term, the leaps, can expire in January, normally, January of 2013 into January of 2014. And leaps for 2015 will start to be written soon. And you can see over on the left the column that says strike price. The yellow background means these contracts are in the money. That is, the strike price is actually lower than the current market price for shares of stock. And these contracts sell for the figures that are listed in the third column. So it starts at $17.90 with a strike price of 15, and a strike price of 50 has a selling price of a nickel, 5 cents. And what that price means is that you're entering into an agreement, if you buy the call, to pay the person. Let's say you're looking at a contract with a strike price of $42.50. You're entering into agreement where you will pay that person 97 cents per share for the right to buy the contract at buy shares from him or her at $42.50 each, any time up to the expiration date, which is July 20th. And the person on the other end of the contract who receives that premium, that 97 cents per share, has the obligation to sell them to you if so asked. And in our case, we're going to be the writer or the seller of the contract, so we're going to be the person that gets this 97 cents per share. And if on the expiration date, which actually is technically Saturday, July 21st, if the contract is in the money, that is, the market price for TJX is $42.51 or more, then the shares will be called away from us at $42.50 each. That's what we will be paid. We've already surrendered 97 cents, by the way, so we really actually won't make, we've already received 97 cents for that right, so the person on the other end is actually not going to really receive money or profit until the price goes higher. But that's what we would do in the short term. For our 43 cents, we would earn 43 shares. We would earn 97 cents per share for writing a contract, a fraction of a contract.
And Hugh, for purposes of a club type environment like this, I wonder what you would think of going to a couple months out or whatever, because this date would happen before the next time we get together. Would it make sense to ever go out into August or October, perhaps to pay a little bit less as a percentage of the transaction, or
you can actually look at the October calls and see what happens if 42 and 50 cents is written for that one, which I think it is. It is. You can see there that you get even more of a premium for it, because prices fluctuate over time, and the underlying asset generally grows in value over time, all else being equal, or at least it has a higher chance of doing that than falling, let's say. That's what the expectation is. So you get actually more money per share. You're getting a premium of $2.45 per share if you push the expiration date out to October.
Mark and Hugh, could I ask a question?
Mm-hmm.
Sure.
I want to put this in different language and see if I still understand it. If I wanted to sell TJX tonight at the club meeting, if we decided we wanted to get rid of it, we could say to ourselves, let's buy a covered call at $42.50 to expire. Let's sell a covered call at $42.50, which is right around where it ended trading today. And let's buy it for October. Somebody will send us $2.45 a share, and that stock will leave our portfolio if the price goes above where we had decided we wanted to sell it anyway at $42.44. Is that right?
Well, actually what normally happens is, because option contracts trade on the CBOE or the NASDAQ or other types of exchanges, the contract that you write will be traded among people at different prices, and they're usually not settled until the expiration date. So it turns out that if the share price is under $42.50 on October the 20th, and if it closes on October the 19th under $42.50, your shares won't be called away. They'll only be called away, presumably, if the shares are higher than $42.50.
So
now,
at
the
that
person
point,
on the other side of the contract has always got the right in the U.S. to exercise the option. But it's generally cheaper to just sell that right to somebody else, sell the option contract on the open market, than exercise it. The transaction costs generally are more to exercise than to sell the right on.
And when do I get the $2.45? Is that an immediate gain, or do I wait for that money?
Well, TD Ameritrade gives it to you immediately, but I know, and I don't understand why. I've never figured this out. People who were doing business with Zeco did not get the premium until the option contract expired, and maybe somebody knows why that is. I don't.
Okay,
but most brokers give it to you right there and then.
And then on October 20th, if the price exceeds $42.50, then those shares leave my portportfolio at a price of $42.50. Is that right?
Yep, regardless of what they're trading in the open market.
So I've made $44.95 really then, right?
Yeah, less a little bit of a commission, but yes.
Absolutely, less commissions, right? Okay, that's making clear. That's clear.
Right, and just to stress, as Hugh was talking about how options tend not to be exercised until very close to the close. For various reasons, they may not even be exercised then. So if you definitely want to sell at $42.50, a covered call may not be the appropriate vehicle, because you may never sell at $42.50. Now, if you're willing to sell at $42.50 and it doesn't break your heart if you don't, then obviously a covered call gives you that premium. And
that's a great sentence. That's a great sentence, if you're willing, but it won't break your heart if you don't.
Yeah.
That's a great sentence. Okay.
But most brokers will exercise the contract if it's at least 1 penny in the money.
Okay.
Unless you call them and tell them not to do it.
We do have a question from one of our attendees. will it actually be this last price that the call is written for, or will it be a price that depends on the market tomorrow morning?
No, it's these strike prices. You could write the call for $37.50 today. If you thought the price was going to drop, you get $6.05 each per share. Sometimes you do the math, you might get a better deal if it's what's called in the money, if it's in that yellow area.
No,
But
the question dealt with the bid and the ask,
Yeah,
the spread.
It's about the premium, Hugh.
Yeah.
It's the spread. The question was about the spread.
It's
Yeah,
in that
right.
respect, it's no different than the stock price. These do fluctuate.
They do
Okay,
fluctuate.
so that was the question. So it might be 250 or 242 or something like that tomorrow
That's
morning, right?
You know,
Okay.
I'll tell you
All right.
what, in the meeting minutes or tacked on as an attachment at our forum, I'll include a description of, a couple of links that help to explain this, but also this notion of how that 245 actually does, that obligation decays down to zero over time.
Okay, we have a hand in the air, and I'm going to recognize John Kimmel. John, you're unmuted. Go ahead.
Well, I'm a new one to options, but I have tried this 3 times on some QQQ in my IRA, and the thing you can do too is, as you're looking at the price and you're looking at the chart, you don't have to take those prices that are given right there. If you're willing to take some risk, you can put in limit orders
right.
on the and try to get a better price, because if you look at the charts on the options, you can see that they do move quite a bit as the stock moves. And sometimes I'll sit there like I did on the Qs and put a somewhat high price, maybe 2 or 3 times as much as what the option's selling for currently. And if it gets up there, then I'll get my price, I'll sell my option, and go from there. But my experience has been mixed. Usually the options, the stock gets called away when you guessed wrong and the price went way up, and then you're still sitting there with the stock, but you kept the premium when the market fell out from underneath you on the thing.
Yeah.
So it's just a trial and error, and it's a real good learning experience.
And by the way, I have used limit options pretty much almost exclusively. I tend not to go for market. And the one thing I'll say is my experience, at least, is options, as you can see over on the right where it talks about open interest, aren't really that liquid. So I've confessed to Mark that on occasion I've actually used call options to try to profit from inflection points in the drug approval process, be it in an advisory committee meeting or the actual approval event itself. And there have been occasions when I've tried to sell a call, to close it. I bought the call option, so I'm the one that pays the premium, and I tried to sell it, so you get a premium back at the selling price. And even though there is a bid and an ask, there are no takers. And when I change it to market, it doesn't happen, and sometimes it's sat there for 2 or 3 days before it actually moves. So these would be on kind of very illiquid NASDAQ-y type biotechs. So just a little bit of just a heads up on that one. This one looks like it's reasonably liquid. If you looked at a Microsoft or some of the other bigger companies, you'd see significant open interest.
Well, Mark, that was certainly an interesting discussion. Shall we try this on TJX at $42.50 for an October contract?
I'm up for it, just as a demonstration, and we can work through it with the people. It's a form of learning to do this on paper and demonstrate how well it works out or not works out.
We don't have any real rules, so Cy, is that okay with you? And Hugh, is that okay with you?
Sure.
Then let's go ahead and try it, Mark, okay?
All right, we'll do it then.
So we're writing it for our 43 shares and change.
Yeah.
Yeah.
Right.
Okay.
It's a
Well, we'll see
simulation.
what happens.
It'll be a simulation, and we'll see what happens.